Welcome to the Explainer. If you are gearing up for your ACCA Financial Reporting exams, you already know the sheer volume of rules can feel, well, totally overwhelming. It's a lot to take in. But today, we're going to change that. We've put together the ultimate high-yield toolkit to demystify 4 of the absolute most heavily tested standards. We're going to build this knowledge efficiently and, more importantly, in a way that actually sticks. Okay, let's dive right into this. We've got a really structured game plan today. First, we'll decode FRS standards generally. Then we're tackling IAS 40 on investment property. From there, we hit IAS 2 for valuing inventory, IFRS 15 on revenue rules, and IFRS 16 on leases. And finally, we'll wrap the whole thing up with a section on how to pass with confidence, basically how to secure those distinction level marks. All right, Section 1, IAS 40, investment property. Let's get into the measurement models.
Now, examiners absolutely love to test the boundaries of different assets. The definition of an investment property is incredibly specific. It's property held specifically to earn rentals or for capital appreciation. The crucial thing to remember here is what it's not. It is not for use in the production of goods, because that would just be your regular property, plant, and equipment. And it's definitely not for ordinary sale. So think of things like a piece of land held for long-term appreciation, or maybe a commercial building you're leasing out to someone else.
Now, what's really interesting is the contrast that hits when we measure these properties after their initial recognition. You basically have a choice: the cost model or the fair value model. The cost model behaves exactly like standard property. You just depreciate it over time. But if you choose the fair value model, there is absolutely no depreciation. Zero. Why? Because you're revaluing it at every single reporting date anyway. Any wear and tear gets naturally captured in that new value. And any gains or losses? They go straight to the profit and loss statement. Keep an eye out for this. It's a massive exam trap. So, if you're taking notes, here's your one-line takeaway. IAS 40 equals property for rentals or appreciation. The fair value model means no depreciation, with gains or losses going directly to the P&L. Lock that in. Let's move to our next standard and add another tool to the kit.
Module 2, IAS 2, valuing inventory, specifically looking at the lower of cost and NRV.
So, the golden rule of IAS 2 is that inventory must always be valued at the lower of cost and net realizable value, which we usually just call NRV. But here's the real secret, the thing students miss all the time, that last word, individually. You do not just group all your inventory together and compare the big totals. I mean, you wouldn't group a bunch of high-end laptops with a box of rusty nails, right? You have to apply this rule strictly on an item-by-item basis.
Let's break down the math real quick. On the cost side, that includes your purchase price, import duties, transport inwards, and any conversion costs like direct labor. On the flip side, your NRV formula is your estimated selling price minus any costs required to actually complete it minus the cost to sell it. It's pretty logical when you think about it. If that NRV ever drops below your cost, you have to write the inventory down, and boom, that expense hits your P&L immediately.
All right, so your anchor for this module is simple. Inventory equals the lower of cost and NRV per item. Remember that individual item rule, and you're going to confidently navigate any inventory adjustment the examiner throws your way.
Moving right along to Section 3, IFRS 15, revenue rules. Let's talk about the famous 5-step model.
Revenue is the top line of the income statement, right? It's a huge deal, and the accounting world treats this specific standard like a very strict recipe. The old days of recognizing revenue just because risks and rewards transferred, yeah, those are completely gone. The new absolute trigger word you need to know is control. You recognize revenue only when or as control of the goods or services actually transfers to the customer.
To figure out exactly when that control transfers, IFRS 15 mandates this step-by-step recipe. Step 1, identify the contract with the customer. Step 2, identify the distinct performance obligations. Basically, what exactly did you promise to deliver? Step 3, determine the transaction price, and always keep an eye out for variable consideration there. Step 4, allocate that price to those distinct performance obligations based on their standalone selling prices. And finally, Step 5, recognize revenue when or as those obligations are satisfied. Look, missing even one step ruins the whole recipe, so you have to apply these sequentially to whatever scenario you get.
Now the final hurdle of Step 5 is figuring out how that control actually transfers. Did it happen over time or at a point in time? Well, it happens over time if the customer consumes the benefits as you go. Think of a long-term construction build or maybe a daily office cleaning service. Otherwise, It transfers at a point in time, which is usually when the customer takes physical possession of the product, handing over the keys, so to speak. So, your quick revenue summary. IFRS 15 is 5 steps. Revenue happens when control transfers, and you absolutely must allocate the price to distinct obligations. Keep this logic crystal clear in your head, and you'll dominate those revenue questions.
Section 4 already? IFRS 16, Leases Unpacked. Time to explore lessee accounting.
This is a big one, guys. This standard fundamentally changed accounting. Before this rule, companies were hiding billions, literally billions, in leased assets off their balance sheets. We're talking about airlines hiding entire fleets of airplanes. Crazy, right? Now we actually have to identify if a lease exists. It's defined as a contract that gives you the right to control the use of an identified asset for a specific period in exchange for consideration. If the supplier can easily just swap the asset out for another one, well, it might just be a standard service contract, not a lease. So the crucial point is how this actually hits the lessee's balance sheet. A lessee must recognize a right of use, or ROU, asset and a corresponding lease liability, which is calculated as the present value of the lease payments. Going forward, it's pretty standard. The ROU asset is depreciated over the lease term, and the liability increases with interest and decreases as you make payments. But here is your lifeline. There are 2 major exemptions where you can skip this complex math. You can just expense the lease straight to the P&L if it's a short-term lease of 12 months or less, or if it involves a low-value asset. We're talking about things like a tablet or a laptop worth about $5,000 or less. Let's lock this final standard in. For IFRS 16, a lessee recognizes an ROU asset and a lease liability. You depreciate the ROU, calculate interest on the liability, and always watch out for those short-term and low-value exemptions.
All right, we made it to Module 5, Pass with Confidence. Let's talk about the exam hacker mindset.
You know, memorizing the rules is really only half the battle. To actually pass, you've got to apply these standards to the specific facts they give you in the scenario. If you just write down generic textbook definitions, you're going to get 0 marks. Seriously, you have to show exactly how the standard solves the specific company's problem. Oh, and always reference the standard numbers. Just writing under IFRS 15 immediately signals to the grader that you know exactly what you're doing. And finally, please show all your workings. Even if you make a silly calculator slip, having clear step-by-step methods will secure you those super valuable partial marks.
Think about it. You've just absorbed the high-yield blueprints for investment property, inventory, revenue, and leases. You know exactly what the examiner is looking for now. You have the formula for success. Now it's entirely up to you to execute on it.
As we wrap up this explainer, I really want to leave you with a quick thought. You have the formula, but will you actually apply the logic? Don't just sit on this knowledge. Take these concepts straight into your practice platform today. Apply them to a real scenario and just watch your scores climb. Thank you so much for joining me today, and I'll catch you in the next explainer. Welcome to the explainer. Today, we're decoding 3 of the absolute hardest ACCA financial reporting standards.
Right, let's dive in. How do we account for the unpredictable? Well, enter IAS 37.
A provision isn't just regular debt. It's a liability where the timing or amount is totally uncertain.
To actually recognize one, you absolutely need a present obligation, a probable outflow, and a reliable estimate.
Got a possible obligation? That's a contingent liability. Disclose it in the notes, but never recognize it.
For onerous contracts, recognize a provision for the lower of fulfillment cost or the termination penalty. So remember this one-line summary. Seriously, burn it into your memory for exam day. Okay, moving to IAS 12. The core formula? Temporary difference equals carrying amount minus tax base. Taxable differences create deferred tax liabilities, while deductible differences create deferred tax assets. Simple as that. But watch out for this trap. Unused tax losses only create an asset if future profits are probable. Then, just multiply that difference by the tax rate. That's your absolute golden rule here.
Next up, IFRS 9. How do we classify financial assets? It's basically a 2-part test.
You got to look at the business model and see if cash flows are solely principal and interest.
Hold to collect means amortized cost. If you're also selling, it's fair value through OCI.
For impairment, we use 3 stages of expected credit loss, jumping from 12-month right up to lifetime.
Examiners love this trick. Trade receivables always use lifetime ECL, usually through a provision matrix.
Equity defaults to FVTPL, but you can irrevocably elect FVOCI at the start.
So let's review. Find those obligations, compare carrying amounts, and always double-check the business model.
You've got the logic, the triggers, and the traps. Now go crush that next financial reporting exam.
Hey everyone, let's jump right into this. If you're studying for your ACCA Financial Reporting or SBR exams, consider this explainer your ultimate cheat code. Today, we're completely manstraying the asset lifecycle by decoding the core ACCA FR standards. We're going to take a single asset and trace its entire journey, from the foundational rules that govern it, through its physical or even invisible creation, all the way down to its potential downfall. All right, here's our roadmap for today. Number 1, foundation in IAS 1. Number 2, tangible assets, IAS 16. Number 3, intangible assets, IAS 38. Number 4, asset impairment under IAS 36. And number 5, final exam strategy. Starting off with Section 1, Foundation and IAS 1 Framework Concepts. Think of the conceptual framework as the invisible hand guiding literally all standard setting and accounting choices. Now, the framework isn't actually an accounting standard itself, right? It's more like the fundamental philosophy behind everything. Its whole objective is to provide financial information about a reporting entity that's genuinely useful to investors, lenders, and creditors. And it does this based on qualitative characteristics, primarily ensuring that the information has both relevance and faithful representation. Under IAS 1, those abstract concepts become reality through a complete set of financial statements. This requires 5 specific components: the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flows, and finally your notes, which include accounting policies. So, the absolutely crucial point here is the baseline assumption for all of this, the going concern assumption. You always assume the entity will continue for the foreseeable future, which means at least 12 months from the reporting date. Take a mental screenshot of this one-line summary. IAS 1 equals full set of statements, current and non-current classification, and the going concern assumption. Seriously, lock that anchor in your mind, because it is the baseline for everything else we're going to discuss. Moving right along to Section 2, Tangible Assets, IAS 16, Real-World Assets. When we initially recognize property, plant, and equipment, we measure it at cost, and that includes the purchase price plus directly attributable costs, like installation. But for subsequent measurement, we get a choice between 2 models. We have the cost model, which is just historical cost minus accumulated depreciation and any impairment losses, or we can use the revaluation model, which records the asset at its fair value minus subsequent depreciation and impairment. Now, listen up, because here's a massive exam trap. If you revalue an asset upwards, so many candidates forget to recalculate the depreciation. You must depreciate that newly revalued amount over its remaining useful life. If you do go with the revaluation model, you need to know exactly where the money goes. An increase in value, that goes straight to other comprehensive income, or OCI, and it sits safely in a revaluation reserve in equity. A decrease, well, that hurts. It goes directly to the P&L as an expense. But watch out for the exception, because examiners literally love testing this. If you are reversing a previous decrease that already hit the P&L, your new gain goes to the P&L first to completely cancel out that old loss. Do not fall for the trap of putting initial revaluation gains in the P&L. Here is your IAS 16 one-line summary. PPE at cost or revaluation. Depreciate over useful life, revaluation gain to OCI. Consolidate your understanding of physical assets right around this single powerful sentence. But let's pause for a second. What if the asset has no physical form? How do the rules change when the asset you've just spent millions of dollars generating is completely invisible? That brings us perfectly to Section 3, Intangible Assets, IAS 38, Invisible Assets. For internally generated intangibles, IAS 38 splits your project into 2 very distinct phases. The research phase is incredibly strict. You must expense all costs to the P&L immediately as they're incurred, no exceptions. But the development phase? Well, you can capitalize those costs as an asset, but only if 6 strict criteria are met. There's another huge exam trap here. Students love to automatically capitalize development costs the exact moment a project moves past research. You can't do that. You must verify all criteria, things like technical feasibility, intention to complete, and probable future economic benefits, before a single dollar gets capitalized. Okay, so once you've successfully capitalized that intangible asset,
how do we handle its value over time? If it has a finite, foreseeable life, you simply amortize it over that useful life. But if it has an indefinite life, meaning there's literally no foreseeable limit to the period it will generate cash flows, there's no amortization. Instead, you're required to subject it to an annual impairment test, regardless of whether there are any actual indicators of a decline in value. Time for your IAS 38 one-line summary. Research expense, development capitalize if criteria met, amortize finite life intangibles. Just memorize this binary rule. I promise it'll bring you immediate clarity in the exam hall. All right, Section 4, Asset Impairment, IAS 36, the worst-case scenario. The absolutely crucial point here is understanding the core trigger. An impairment loss occurs strictly when an asset's carrying amount is greater than its recoverable amount. Think of it like this. If your balance sheet says a machine is worth $1 million, but the absolute maximum economic benefit you can squeeze out of it is only $800,000, well, you've got an impairment. You must write it down. Let's walk through the exact math of IAS 36. Step 1, identify the carrying amount. Step 2, determine the recoverable amount. Now, recoverable amount is defined as the higher of fair value less cost to sell, meaning what you'd get if you sold it today, and value in use, meaning the cash it'll generate if you just keep using it. Step 3, record the impairment loss. And here is some vital SBR examiner intelligence. When calculating value in use, you absolutely must use discounted cash flows. Whatever you do, do not use undiscounted cash flows.
A lot of the time, an asset doesn't generate cash entirely on its own, so we have to test a whole group of assets together. We call this a cash-generating unit, or CGU. When you have an impairment loss for a CGU, there is a strict pecking order for allocating that loss. Rule number 1, always destroy goodwill first. Reduce goodwill all the way to 0. Then, step 2, allocate the remaining loss pro rata to the other assets based on their carrying amounts. But remember the floor rule. You can never, ever reduce an individual asset's value below its own fair value less cost to sell, or below 0.
Let's cement this standard. Your one-line summary, impairment equals carrying amount greater than recoverable. Recoverable is the higher of VIU and FVLCS. Allocate to goodwill first. Lock that definitive rule in.
Finally, Section 5, Final Exam Strategy, Passing the ACCA Exam. Let's look at some insider intelligence, the most common traps students fall into, straight from the examiner reports. Exam mistake 1, sending a revaluation gain to the P&L. The quick fix, revaluation gains go to OCI, unless you're reversing a previous loss. Mistake 2, auto-capitalizing development costs. The quick fix, you've got to check all 6 criteria first in the scenario before doing anything. Mistake 3, using undiscounted cash flows for impairment. The quick fix, value in use must always use discounted cash flows because, the time value of money. Technical accuracy is expected for sure, but applying it to the scenario is what actually gets you the marks. The examiners explicitly state that candidates who just recite standard definitions fail. You have to reference the specific standard number, like IAS 16 or IFRS 15, and apply those rules directly to the company facts given in your prompt. That is how you earn those application and professional judgment marks. So I'll leave you with this final real-world provocation. If your company's recently revalued factory suddenly suffers a massive fire, how exactly will you cycle through IAS 16 and IAS 36 to save your balance sheet? Think about that revaluation reserve you built up. Think about the impairment trigger and how you'll calculate the new recoverable amount. I dare you to go tackle a practice question on this exact scenario right now. Thanks for joining me on this explainer, and keep mastering those standards.
Welcome back to the explainer. All right, let's just dive right into this, shall we? Today, we're basically putting on our hard hats and stepping right onto the construction site of corporate finance. We're going to be looking at a fast-paced, step-by-step blueprint for mastering what is honestly one of the most mechanically complex areas out there: corporate group accounting and consolidation. We're taking all those scattered building blocks, the parent companies, the subsidiaries, fair values, unrealized profits, and we're going to show you exactly how they all fit together to form one unified, consolidated economic entity.
But hey, before we actually start building anything, we really need to talk about the stakes here. If you're studying for your ACCA exams, particularly financial reporting or strategic business reporting, you absolutely need to hear this harsh truth straight from the examiner's notes. Quote, "If you cannot consolidate, you cannot pass." End quote. Wow. Group scenarios are literally guaranteed to appear. But here's the good news. Consolidation, it's a highly logical, highly repeatable process. Once you actually see the underlying structure, what looks like this chaotic mess of numbers just becomes a totally predictable, completely solvable puzzle.
So, here is the builder's blueprint we're following today. 1. Defining control under IFRS 10. 2. Goodwill and business combinations. 3. The basic consolidation recipe. 4. Mastering fair value adjustments. And finally, 5. Cleaning up unrealized profits.
Okay, starting off with Section 1, Defining Control under IFRS 10.
Listen, before we go combining any financial statements, we have to lay down the rules of the game. We have to know if we even have the right to build this consolidated house in the first place, right? So the absolutely crucial starting point is answering this. When does a parent truly control a subsidiary? Now, for decades, the easy answer was just, well, owning more than 50% of the voting shares. Done. But today, modern corporate structures are way more complex than that. You can own a massive majority of shares and still not actually call the shots. Or conversely, you can own a minority of shares and basically run the whole show. Standard setters realized pretty quickly that they needed a much more robust definition.
And what they came up with are the 3 pillars of control. Under IFRS 10, you literally must have all 3 of these structural supports firmly in place if you're going to consolidate. First up, you need power over the investee, meaning you actually have existing rights that give you the ability to direct the relevant activities. Second, you need exposure or rights to variable returns, so your financial outcome is directly linked to how the subsidiary performs. And third, the ability to use your power to affect those returns. Now look, yes, having over 50% of the voting rights is usually the most obvious indicator of these 3 pillars, but as an accountant, you have to make absolutely sure all 3 are completely rock solid before you consolidate.
Moving right along to Section 2, Goodwill and Business Combinations under IFRS 3.
Okay, so once control is a sure thing, we move into the materials phase of our blueprint. The parent company has gone out, they've bought the subsidiary. But here's the thing, they almost always pay a premium over what the subsidiary's individual assets are actually worth on paper. That premium, that's what we call goodwill. To calculate this, we just use a straightforward math stack. At the top, we take the consideration transferred. That's the cash or the shares the parent actually paid. We add to that the value of the non-controlling interest, the minority shareholders' piece of the pie. Together, those 2 numbers represent the total implied value of the entire subsidiary. Then we just subtract the fair value of the net assets acquired. The difference, that leftover premium at the bottom, is our goodwill. It represents the value of the brand, the customer lists, the synergies, basically the invisible magic of the business.
But watch out, because right here is an absolute classic trap set by examiners. Notice how we value that non-controlling interest, or NCI? Well, you actually have a choice. Under the full goodwill method, the NCI is measured at fair value, which is often just based on the active market share price. This means the NCI gets its own little slice of the goodwill pie. But if you're using the proportionate share method, the NCI is strictly measured as their percentage of the net assets only. Period. No goodwill is attributed to the minority. Getting this wrong will fundamentally warp your entire goodwill calculation, so always double-check the specific policy being used.
All right, on to Section 3, the basic consolidation recipe.
The foundation is poured. The materials are on site. Now it is time to frame the house. This is the moment we take the separate financial statements of the parent and the subsidiary and fuse them together into a single economic entity. Think of this core mechanical engine kind of like an offensive playbook in sports, okay? It's a high-speed 4-step drill. Step 1, we sweep across the board, adding the parent and subsidiary's assets and liabilities together, line by line. Step 2, we literally cross out the parent's investment in subsidiary line item because, well, you can't be invested in yourself. Step 3, we drop in that goodwill figure we just calculated. And Step 4, we make our granular adjustments for fair values and unrealized profits. Just like that, the separate entities vanish and the unified group emerges.
Which brings us to Section 4, Mastering Fair Value Adjustments. Let's drill a bit deeper into that final step. Remember, when a parent buys a subsidiary, they don't just magically adopt the subsidiary's old historical book values. No way. They have to revalue everything to its fair value right on the date of acquisition. And guys, this creates a massive ripple effect. Seriously, if you remember absolutely nothing else from this explainer, remember this golden rule punchline. Fair value steps up assets, extra depreciation eats into post-acquisition profits. I'll say it again.
When you revalue an asset, like say a giant factory, upwards on the day you buy the company, that larger asset value is absolutely going to generate larger depreciation charges in the years to come.
So this creates a really interesting dual effect. On day one, at acquisition, it's strictly a balance sheet adjustment. You increase the subsidiary's asset value to its true fair value, which conversely affects your initial goodwill calculation. Super straightforward. But the real tricky part is post-acquisition. Years later, you have to calculate the extra depreciation on that fair value uplift and then deduct it from the subsidiary's retained earnings in your consolidation workings. It's this sort of creeping profit and loss impact that examiners just love to test you on.
Okay, final stretch. Section 5, Cleaning Up Unrealized Profits.
We have finally reached the last coat of paint on our house, hunting down and eliminating hidden unrealized profits. This is absolutely crucial for getting the true value of the corporate empire. The golden rule of a single economic entity is that you cannot make a profit by selling things to yourself. I mean, think about it. Imagine you move a flat-screen TV from your living room into your bedroom, and then you charge yourself an extra $100. You aren't actually any richer, right? It's the exact same concept here. If the parent company sells inventory to the subsidiary for a profit, and that inventory is just sitting there unsold in a warehouse at year-end, well, that profit is unrealized. We have to strip that inflated revenue and the fake profit right out of the consolidated statements.
But here is the massive aha moment that trips up so many people. Who actually takes the hit for that elimination? Well, it entirely depends on the direction of the sale. In a downstream sale, so the parent selling to the subsidiary, the profit was obviously made by the parent, so we eliminate 100% of that unrealized profit straight out of the parent's retained earnings. Simple. But in an upstream sale, where the subsidiary sells to the parent, the profit was made by the subsidiary. And because the minority shareholders actually own a piece of that subsidiary, eliminating that profit hits the subsidiary's retained earnings and proportionally reduces the non-controlling interest. You see? Upstream sales are super dangerous because they directly impact the minority.
So, look at that. We've built the house, we've defined control, calculated the goodwill premium, consolidated the lines, adjusted the fair values, and scrubbed out all those fake intra-group profits. We've officially mastered the mechanics of building a group. But I'm going to leave you with a bit of a provocative thought here. What happens when it's time to tear the house down? Like, what actually happens to the consolidated balance sheet, the goodwill, and the non-controlling interest on the exact day the parent loses control and disposes of the subsidiary entirely? That whole process of deconsolidation is a completely new puzzle, and honestly, a perfect topic for our next exploration. Keep studying the blueprint, and I'll see you in the next explainer.
Hey everyone, and welcome. Get ready because today I am absolutely stepping in as your personal exam coach. We're going to decode the ACCA Financial Reporting syllabus together in this explainer. Now, we are looking at a very specific, highly tested theme today, the accounting timeline. We're going to master IAS 7, IAS 8, and IAS 10, and we're bringing these seemingly dry standards to life by figuring out exactly where they fit on our timeline. So, are you ready to lock in those ACCA FR marks? I know you are. Okay, let's dive right into this. This explainer is all about high-yield, exam-focused revision. We aren't just, memorizing definitions here. We're looking at the exact mechanical fixes that will save you from those classic pitfalls the examiner literally loves to set up. By the end of this, you'll know exactly how to secure those crucial marks. All right, here's our roadmap for today. First up, tracking cash with IAS 7. Second, time travel with IAS 8. Third, the twilight zone with IAS 10. And finally, we'll wrap up with exam traps. Let's jump into Section 1, Tracking Cash, the cash flow reality. The crucial reality we really have to face is that profit, well, it's mostly just an accounting concept. Thanks to accruals and matching, your income statement might show this massive, beautiful profit, but if the bank account is completely empty, yeah, the business is in deep trouble. So you look at a healthy profit, and you have to ask yourself, where did the cash actually go? It's a provocative question, for sure, but we absolutely have to look beyond the income statement to understand the real liquidity and viability of a company. And that brings us to the formal definition of IAS 7. This standard basically requires us to reconcile that paper accounting profit to the actual physical cash movements. It's brilliantly structured around categorizing those cash movements into 3 very distinct buckets, making sure every single dollar in and out is accounted for. Those 3 buckets are operating activities, which is just cash from everyday trading, investing activities like buying or selling non-current assets, and financing activities, which covers things like issuing shares, taking out loans, or paying dividends. Literally every cash movement falls into one of these 3 steps. Okay, now the sequence for the indirect method of calculating operating cash flow is exactly what you need to memorize for your exam workings. It's a real game changer. You always start with profit before tax. Then you adjust for non-cash items, so you add back depreciation and adjust for gains or losses on disposal, plus any movements in provisions. Then comes the tricky part. Working capital. If receivables increase, it means your cash is tied up with customers, so you subtract it. If payables increase, well, you're holding on to your cash longer, so you add it. If inventory increases, you spent cash to buy it, so you subtract. Seriously, master this specific sequence, and you master IAS 7. So the absolutely crucial point here is captured in our one-line summary. Cash flow equals operating plus investing plus financing. Adjust profit for non-cash and working capital. Say it out loud to yourself. Write it down on a sticky note. This needs to be your mental trigger the second you sit down for the exam. Moving right along to Section 2, Time Travel, Policies, Estimates, and Errors. So while accounting usually just marches forward, sometimes we kind of have to figure out how to deal with changing the rules of the past or estimating the uncertainties of the future. IAS 8 dictates exactly when we are allowed to touch prior year figures versus when we just adjust things moving forward. It deals with 3 distinct things: accounting policies, accounting estimates, and prior period errors. And let me tell you, knowing the difference between these 3 is exactly where the exam marks live. This really illustrates the core battle of IAS 8, retrospective application versus prospective application. Basically, policies and errors look backward. That's retrospective. Estimates look forward. That's prospective. Let's break down the exact mechanical difference here so you don't drop any easy marks. Retrospective application means you have to go back and adjust opening retained earnings and restate the comparative figures from the prior year. You are essentially rewriting history as if the new policy or the correct figure was just always there. Prospective application, much easier. You basically draw a line in the sand, you apply the change only from the date of change forward. No restatement required whatsoever. For example, changing a depreciation method from 10 years to 5 years is just a change in estimate. You apply it right now, prospectively, and move on. Here is your one-line trigger phrase to lock IAS 8 into your brain forever. Policy equals restate, estimate equals prospective, error equals restate. If you can remember this simple formula, you are going to navigate any IAS 8 scenario the examiner throws at you. Section 3, the Twilight Zone, after the reporting date. Welcome to the Twilight Zone. This is that mysterious period right after your year-end date, but before the financial statements are actually published and sent out into the wild. The formal definition of IAS 10 outlines this critical window. We are looking at events occurring specifically between the reporting date, let's say December 31st, and the date the financial statements are formally authorized for issue by the board, which might be all the way in March. The examiner absolutely loves to test what you do with new information that comes to light during this specific time frame. Honestly, everything in this standard boils down to this one comparison. Is it an adjusting event or a non-adjusting event? To figure it out, just ask yourself one question. Did the condition exist at the stroke of midnight on the reporting date? If the evidence points to a condition that existed at year-end, it's adjusting, and you physically change the financial statements. But if it's a completely new condition that arose after the year-end, well, it's not adjusting. You just disclose it in the notes and call it a day. Let's speed through a few classic examiner examples. A customer goes bankrupt after year-end. That is usually adjusting, because it proves they were already in bad financial shape at year-end. Settlement of a court case, adjusting. But what about a fire loss after year-end? Non-adjusting, because the building was perfectly fine on December 31st. A major acquisition or a sudden change in tax rates, also non-adjusting. And please pay very close attention to this last one. Dividends declared after year-end. This is a massive trap. It is non-adjusting. Do not recognize a liability for them at year-end. You only disclose them. Let's hammer home our third one-line summary to completely secure your understanding of the Twilight Zone. IAS 10 equals adjusting, which means it's an existing condition, so you adjust. Non-adjusting means it's a new condition, so you disclose. Keep it exactly that simple. Finally, Section 4, Exam Traps, Securing Your Marks. All right, we are moving into the final stretch here, and the stakes are high. We are focusing purely on what goes wrong in the actual exam room. Please, whatever you do, don't lose easy marks. Let's lock down the examiner's favorite tricks right now so you can walk in and pass with absolute confidence. Let's walk through these methodical fixes. First, the IAS 7 trap. Getting working capital changes backwards. It happens all the time. The fix? Always remember that an increase in receivables is a cash outflow, so you have to subtract it. Think of it like you've essentially loaned the customer money. Second, the IAS 8 trap. Treating a change in an accounting estimate like it's an error. The fix here? Just remember that changing an estimate, like a machine's useful life, is prospective. Do not restate opening balances. And finally, the IAS 10 trap we literally just talked about, adjusting for new dividends. The fix? Dividends declared after the year-end are disclosed only. Never, ever put them in the statement of financial position as a liability. So I'll leave you with this final thought. Have you mastered the accounting timeline? Look at how interconnected all these rules are. Cash flow tells us the real story today. IAS 8 cleans up our past and sets our future estimates. And IAS 10 handles that weird twilight zone right after year-end. If you apply these rules and avoid those classic traps, you will absolutely crush these topics. I hope this explainer has left you feeling confident and hungry to tackle the rest of the syllabus. Keep practicing, you've got this, and I'll see you in the next one. Welcome to today's explainer. We are diving into what I like to call the FR exam triple threat. We're tackling 3 absolute heavyweight accounting standards for your ACCA FR exam: IFRS 5, IAS 21, and IAS 33. Now, if you're prepping for this exam, you already know these can be seriously tricky. But hey, by looking at exactly how they connect in the real world, we're going to spot those common examiner traps and make total sense of these complex rules together. Let's get into it. So here's our roadmap for today. We'll start with the corporate lifecycle hook, then hit IFRS 5 held for sale, followed by IAS 21 going global. After that, it's IAS 33 earnings per share, and finally, we'll wrap up with exactly how to smash your FR exam. All right, part 1, the corporate lifecycle hook. I want you to imagine a company going through a massive transformation, right? Instead of memorizing isolated rules, realize that these 3 distinct FRS standards actually form one cohesive business story. Stage 1, selling off an old division, which is what triggers IFRS 5. Stage 2, taking the cash from that sale to expand overseas, bringing IAS 21 into the mix. And Stage 3, year-end hits, and we're reporting back to our shareholders, demanding a flawless IAS 33 calculation. Connecting them like this, it's going to help us understand the actual business logic. Moving right along to part 2, IFRS 5, non-current assets held for sale. Well, it turns out you can't just casually decide to sell an asset and slap it into this category. No way. It's an all-or-nothing checklist. First, the asset has to be available for immediate sale. Second, that sale must be highly probable within 12 months. Third, management has to actually be committed to selling it, actively searching for a buyer. And finally, marketing it at a reasonable price. So remember, if even just one of these criteria is missing, it absolutely does not qualify for IFRS 5. Okay, so once you've proven the asset actually belongs under IFRS 5, the measurement rule kicks in. You have to measure the asset at the lower of its carrying amount and its fair value less costs to sell, often called FVLCS. Now here is the absolutely crucial point. If that FVLCS is lower than your carrying amount, you've got to write the asset down immediately. That difference, it hits your statement of profit or loss as an impairment loss right then and there. Next up is presentation, and listen, here is a massive trap the examiner loves to set. It gets presented on a separate line in the statement of financial position, usually sitting in current assets because, well, you expect to sell it within a year. But the golden rule? All depreciation must stop immediately upon classification. I see this all the time. It's such a common mistake to just keep depreciating a held-for-sale asset out of habit, but the clock literally stops right there. To really lock this in, here is a great one-line mental trigger for you. IFRS 5 equals held for sale, stop depreciation, measure at lower of CA and FVLCS, separate presentation. Burn that phrase into your brain. Remembering this mantra is going to make the standard practically second nature. All right, Section 3, IAS 21, going global. So back to our story. We've sold the factory, we've got the cash, and now we're expanding overseas. When you're dealing with foreign currency at the reporting date, your balance sheet basically splits into 2 camps. Monetary items, think cash and payables, are retranslated at the closing exchange rate, and any differences go straight to profit or loss. But your non-monetary items, things like historical cost inventory or equipment, you just leave them alone at their historical rate. Simple as that. But what happens when you buy a whole foreign subsidiary? The rules completely shift. When translating a foreign subsidiary's financials into the parent's currency, the statement of profit or loss is translated at the average rate. But the statement of financial position? That's translated at the closing rate. And because doing this naturally creates an imbalance, those resulting exchange differences don't hit your standard P&L. Nope, they go straight to other comprehensive income, or OCI, specifically into a currency translation reserve. And honestly, here is a fantastic cheat code for you. The ultimate one-line trigger for foreign exchange questions. IAS 21 equals monetary items retranslate at closing rate to P&L, foreign sub-translation differences to OCI. Seriously, this simple phrase is an absolute lifesaver when things get confusing with those giant exchange rate tables on exam day.
Moving to Section 4, IAS 33, earnings per share.
Okay, so we've sold our assets, we've gone global, and now what? Year-end has arrived. Time to calculate earnings per share. The basic EPS formula looks pretty simple on the surface, right? It's just profit attributable to ordinary shareholders divided by the weighted average number of ordinary shares. But that word weighted is key. For example, if new shares are issued for cash on July 1st, they've only generated capital for 6 months of the year, so they've got to be weighted by 6/12.
But here's a really interesting curveball for you. What happens to your EPS calculation if there's a mid-year bonus issue, or maybe a share split? Think about it. The company issues new shares to existing shareholders, but no actual cash changes hands. So how on earth is that handled?
Well, here is the punchline, and watch out because it's a massive exam trap. You absolutely must restate prior year EPS as if those shares had always been an issue. Why? Because a bonus issue doesn't bring in any new resources to the business. It literally just slices the exact same pie into smaller pieces. So to make this year comparable to last year, you treat those bonus shares as if they existed from day one of the earliest period presented. Missing this restatement? It is a guaranteed way to drop easy marks.
Finally, IAS 33 also requires you to disclose diluted EPS. I want you to think of this as the worst-case scenario for shareholder earnings. It includes potential ordinary shares, things like options or convertible bonds, assuming they all triggered and actually became shares. Basically, it shows your existing shareholders exactly how far their slice of the pie could shrink in the future. So, our third and final summary trigger to complete your mental map is this. EPS equals profit divided by weighted average shares. Restate for bonus issues. Diluted includes potential shares. Keeping this straight in your head makes the math so much less intimidating.
And finally, Section 5, smash your FR exam. Looking back at our whole corporate journey today, 3 major exam traps really stand out. Number 1, never ever depreciate IFRS 5 assets once they're classified as held for sale. Number 2, never translate non-monetary IAS 21 items at the closing rate. You got to keep them at historical cost. And number 3, always restate your prior year IAS 33 EPS for a bonus issue. Think about the journey we just took together. You've navigated restructuring and asset sales under IFRS 5, you've handled complex foreign currency expansions under IAS 21, and you've expertly calculated shareholder returns under IAS 33. So, I have to ask, if you can understand the real business logic connecting all these rules, what is stopping you from completely dominating this exam? Take this mental framework, dive straight into your practice questions, and go get those marks.
Listen to me closely. If your ACCA exam is literally days away and you're feeling totally overwhelmed, just stop right now. Take a deep breath. You are in exactly the right place. Welcome to this Masterclass Explainer. I'm here to execute a rapid-fire, completely no-fluff rescue mission to get your brain locked in and exam ready. We're cutting out all the noise, dropping the textbook filler, and focusing exclusively on the high-yield, pure signal concepts that are going to drag you across that pass mark. So I need your absolute, undivided focus for the next few minutes. Let's get into it.
I want this to burn into your memory right now. You will learn more from your mistakes than from any notes. Listen, this isn't just some cheesy motivational poster. This is your absolute battle cry for these final hours. Stop passively reading endless pages of text. The ACCA examiner is not going to test your ability to highlight a textbook. No way. They are testing your ability to navigate their traps. And honestly, the absolute fastest way to learn how to dodge those traps?
Fall into them right now, figure out exactly why you fell, and make sure you never, ever do it again.
So here is our 3-step game plan to get you exam ready. Number 1, ultra-fast revision. Number 2, common exam mistakes and fixes. And number 3, practice strategy.
Let's kick things off with Section 1, ultra-fast revision.
All right, shift your brain into top gear right now. No more long paragraphs. We are hardwiring one-line triggers into your mind so they fire off automatically. Boom. Adjusted present value. If you're sitting advanced financial management, this is an absolute must-know. APV literally separates the operating NPV from the financing side effects. You need to instantly generate this formula in your head. Base case NPV plus the present value of the tax shield on debt minus your issue costs plus the present value of any subsidized loan benefits. Drill that exact sequence. Base plus tax shield minus issue plus subsidy. Lock it in. Okay, let's see how fast we can trigger your recall across different papers. Ungearing beta, you're removing financial risk using 1 minus the tax rate. Target costing, it is always the target selling price minus your desired profit, and you absolutely must close that gap with value engineering. Throughput, it's simply your sales revenue minus direct material cost only, and your entire goal is to maximize it per bottleneck hour. Lock these associations into your brain immediately. Now let's talk relevant costs. These are strictly future incremental cash flows. I honestly cannot emphasize those two words enough. Future, incremental. You know, the examiner absolutely loves to bury sunk costs, like market research you've already done or machinery you've already bought, deep into the scenarios just to waste your time and destroy your calculations. Listen to me. If it's already spent, it is sunk. Ignore it completely and move on.
Let's keep this intense pace going. Notice how quickly we can switch contexts here, just to prove your memory works. In advanced performance management, dysfunctional behavior means gaming the system, short-termism, or budgetary slack. Now, switching to tax, BAR-DR, that's business asset disposal relief, means a 10% rate up to a $1 million lifetime limit. Back to PM, shutdown decisions. We only shut down if the avoidable fixed cost savings are strictly greater than the lost contribution. Snap, snap, snap. That is exactly how fast your recall needs to be.
So, why do good students fail ACCA exams? Think about that for a second. I mean, they know the formulas, they've read the books, so why do they get 48 or 49% and fail? Well, it's because they walk blindfolded right into the examiner's favorite traps. Let's fix that right now. Which brings us to Section 2, Common Exam Mistakes and Fixes. This is your ultimate shield. We're bringing the energy right back up to maximum, because here is where you secure those extra 5 to 10 passing marks that will literally flip a fail into a solid pass. A classic, heartbreaking rookie error in APV calculations is using the WACC to discount the base case NPV. Doing that drops easy marks instantly. The brilliant fix? Base NPV must always be discounted using the ungeared cost of equity, or KE. Do not let financial leverage contaminate your base case. Separate it out. Now here is a massive trap in performance management. The mistake is spotting a target costing gap, doing the calculation, and just stopping. You calculate the gap is $10 and you move on. No! The fix here is you must always recommend value engineering actions to close it. Standardize components, substitute cheaper materials, simplify the design. If you stop at the math, you're literally leaving half the marks sitting right there on the table.
So the crucial point here regarding divisional performance is this absolute examiner favorite. The mistake is blindly trusting return on investment, or ROI. You see, ROI tricks managers into sub-optimization. They'll reject a great project just because its return is slightly lower than their current division average, even if it completely beats the corporate cost of capital. It's crazy. The fix? Use residual income, or RI. RI gives you an absolute monetary amount and is the ultimate savior for making decisions that actually align with shareholder value. Okay, if you're taking the UK tax paper, do not ever mix these two up. The mistake is treating exempt VAT supplies as if they're zero-rated. They are totally different beasts. The fix is knowing that zero-rated means the tax rate is 0%, but you can still recover your input VAT on purchases. Exempt, on the other hand, means there is absolutely no input VAT recovery allowed. Hit that distinction like a hammer in your mind so you never, ever mix up input recovery rules again.
Moving on to our final phase, Section 3, Practice Strategy.
We're shifting from defense straight to offense.
You have the rapid-fire triggers, you know the traps, but how are you actually going to spend your final 48 or 72 hours? I need you to follow these 3 exact steps. Step 1. Attempt the objective test questions and mocks in the ACCA free practice platform. Step 2. The timer is on. No pausing to check a textbook, no pausing to grab a coffee. You absolutely must simulate the brutal reality of the exam hall to build your stamina. And Step 3. Review your mistakes deeply, because honestly, that is where the actual learning happens.
I want you to screenshot this golden review template right now. Seriously, do it. For every single question you get wrong from here on out, you're going to do a forensic breakdown. What was the question? What was your answer? What was the correct answer? Why were you wrong? Was it a math error or a concept gap? And finally, what is the fix? If you use this framework for everything, your scores will absolutely skyrocket.
Now, let's look at this incredible rule and really build your confidence. Show all workings. Even if the final number is completely wrong, method marks count. Listen, the examiner is not your enemy. They actually want to pass you. If you multiply by the wrong tax rate in step 1, but your logic for steps 2, 3, and 4 is perfect, you are getting those marks. You just have to show your logical steps. Do not just write down a naked final number.
Here is an exclusive insider tip just for you in these final, high-pressure days. Take screenshots of the MCQs you get wrong. Create a dedicated album on your phone. Then revise them every single morning the minute you wake up and every single night right before you go to sleep. What you're doing is training your brain's pattern recognition. When you finally sit in that exam hall, your brain will instantly recognize the shape of the questions that used to trick you. It's a real game changer.
0. There is absolutely 0 negative marking in ACCA. You must never, ever, under any circumstances, leave a question blank on the practice platform or in the real exam. If you're down to the last 10 seconds, just guess. A blank answer is a guaranteed 0. A guessed answer? That's a 25% chance of a mark. Leave nothing blank.
Okay, take a deep breath. You have the tools, you understand the triggers, you know the traps, and you have the practice strategy. Now, you just need to apply them with absolute confidence. The hard work is already done. Now, you just need to execute. Go in there and pass this exam.
So I leave you with this final provocative challenge. Will you let the examiner's traps beat you, or will you use your mistakes right now to guarantee a pass? Get off this explainer, log right into the practice platform, start that timer, and go attack your mock exams. You've totally got this.